What's up, guys? Stas here. Welcome back to another video. So we're going to break down why the stock market's going up right now. It's currently about 10:45 a.m. We got some data this morning that's sending the stock market up right now, and this is a good sign when it comes to the Federal Reserve and you know, them doing their job effectively, right? So we're going to break down some data in this video, the markets, my thoughts, my plans, all that good stuff. But before we do that, don't forget to hit the like button and to subscribe. Doing that's completely free, and I appreciate each and every one of you watching as always. And if you guys want some stocks, hey, and you want to support the channel a little bit more, check out that link down below for Moomoo. You get up to 16 stocks, each up to $2,000, and one of those is guaranteed to be either Google stock or Tesla stock, depending on how much money you deposit. But if you deposit at least $100, you get 5 stocks guaranteed. Each of those could be valued up to $2,000. So get on it, guys. Use that link down below. And with that being said, cheers. Let's dive right into the video. So you guys probably saw my last video of the day, right? Or the one before this one, where we talked about the September effect and how historically the markets are, well, not the best in September. The funny thing is right now we're up on the first day of September, and we got some data this morning that maybe could cause a rally, at least here in the beginning of the month. And of course, just because on average September is not a great month, it doesn't mean that this September in 2023 is going to be a bad month, right? For all we know, this could be the year where we have a good month for September, right? But either way, right now we are up, especially on the S&P Dow and the Russell. Now the NASDAQ is pretty much at break even, actually slightly going red. We'll loop back around maybe later in the video to see what's going on, or you know, how these progress over the next 5-10 minutes. But what is causing, or what caused a big move in the pre-market to the point where SPY got to 453, Triple Q got, let me pull that up and see very quickly, Triple Q got up to about 381. What caused this move? Well, it was the unemployment data that we got this morning. And what else was it? Average hourly earnings, the non-farm employment change, right? Let's break down this data right now. Let me actually pull up the Chrome app here, guys. Give me a second. And really, the main piece of data moving the markets is the unemployment rate. You guys can see the unemployment rate right now. Let me actually move my big old head, guys, or let me make my head a little bit smaller. There we go. There we go, guys. So we can see this morning we got the GDP month-over-month number. That was out of Canada, so we're not going to focus on that in this video. We're going to focus on the U.S. data. Under that, we can see here we got average hourly earnings month-over-month, which this shows the change in price, or the price businesses pay for labor, excluding the farming industry, right? And it's a leading indicator of consumer inflation. When businesses pay more for labor, the higher costs are usually passed on to the consumer, as we all have learned, over the past couple of years. And a lot of us already knew that. It's a pretty basic fundamental of business inflation. When prices go up, the businesses are not going to eat that cost, guys. They're going to get passed on. The prices will get passed on to the consumers, right? So look, that came in at 0.2%, which it looks like that was under the forecast. Let me come down here. Yeah, the forecast was 0.3%. And last time it was 0.4% last month. So that has definitely cooled off when it comes to average hourly earnings month over month. For sure is cooling off, 0.2% versus the 0.3% estimate. And you guys can see here the non-farm employment change. You can see right here came in at 187,000. Last month it was 157,000, and forecasted it was roughly at 169,000, right? And this is, of course, the change in the number of employed people during the previous month, excluding the farming industry. So that actually came in above the forecast, where last month it was actually under the forecast. Either way, this is very important because job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. Of course, you guys know a lot of the GDP here in the U.S. is made up of people just buying a bunch of crap, right? Consumerism. So unemployment rate, this is really important here, and we got a big spike in the unemployment rate. Maybe not a big spike, but still a decent spike. Last month, it was at 3.5%. You guys can see right here, on the top right, 3.5%. And the forecast for this month was, 3.5%. You guys see that right here. And it actually came in at 3.8%. So higher unemployment than expected. And Jerome Powell won't just come out and be like, yes, I am going to raise the unemployment rate. I want you to lose your job so inflation cools off and we get it back to 2.5%. He's never going to come out and just say it blatantly like that. But you bet your you-know-what, one of his goals here as the Federal Reserve chairman is to cool off inflation, fight inflation. He's been doing that, obviously, with the raising of rates. We all know that at this point. But another way to do that is, to cool off the labor market, have the unemployment rate go up. People spend less money. They're conserving more money. So inflation cools off that way. So he's obviously battling it on all angles. And the unemployment rate being up, I know it sucks. People are losing their jobs. And mind you, 3.8% is still a very low unemployment rate. But it is up. That's actually good for the stock market, because what that means is, that they're not going to go as hard, the Fed that is, on raising rates even higher. Because it looks like here, at least as of now, what they've already done seems to be working. Inflation's come down. Now unemployment, the unemployment rate's starting to creep up a little bit. Now let's say the unemployment rate, it was at 3.5% last month. Let's say, for example, it came in at 3% this month or something crazy. Yeah, stock market would not like that. That would put more pressure on the Fed to maybe raise rates even more aggressively, which would then cause a drop in the market. So really what the markets are pricing in right now, guys, and what they might price in over the course of the next couple of weeks, months, who knows, hypothetically, they're pricing in that, the Fed is completing their mission on getting inflation down. But I don't know. You never really know at the end of the day what the next couple of months could hold. For all we know, we get a sudden spike in inflation, and then all of a sudden, the Fed's cranking up rates aggressively yet again. I mean, you never know, which is why I always have diversification in my portfolio, and I always have hedges in place or bets in areas that will do well. Let's say we do get another round of inflation, and that's why I've been buying XLE as of late, which is an energy ETF, and I've owned that for years. I've mentioned this before, but I've really started to buy it again recently here as, kind of not really a hedge, but let's say we do get another round of inflation. And I like energy companies anyway. But let's say we get a huge round of inflation again, which I hope not, but let's say we do. Yeah, oil is going to go up. Energy companies are going to do very well, and they're doing well now. The stocks have been doing pretty well. They're pretty flat on the year. But I think we could get another round of a breakout on XLE, which is kind of one of my I don't even think it's a contrarian bet. Do you guys think it is? I don't know. But this shows you right here, the unemployment rate is still pretty low, arguably under 4%, 3.5%, 4%. I mean, that's not even arguable. It is low. So if we start breaking towards 4.5%, 5%, that's going to be obviously what Powell wants to see. Is that going to be great for the economy? Probably not, but I think we are at a 1.5-year high at on the unemployment rate. And of course, you guys can see the total non-farm payrolls. That's been dropping down. It's been cooling off over the course of the last 1.5, 2 years. So what do you guys think? Let me know your thoughts down below in the comments on anything that we've covered in this video. And look at that. Now the markets are slowly starting to turn red. But I'm telling you guys, the closer we get to that, inflation target, the higher the unemployment rate goes, the less chance we get more rate hikes, the more the stock market likes that, and the more green it's going to be, at least in my opinion. What do you guys think? And of course, it's not just going to go straight up in a straight line forever, but the sentiment, of course, is at least in my eyes turning bullish right now as Triple Q's breaking out on the 4-hour chart. SPY's doing the same thing as well. So what do you guys think? Let me know your thoughts in the comments. Hit that like button. Feel free to subscribe. And don't forget to get up to 16 stocks from Moomoo, each up to $2,000, guys. Just use that link down below or go to stocksurfest.com/Moomoo. And keep in mind, one of those stocks, depending on how much money you deposit, is guaranteed to be either Tesla stock or Google stock. And if you deposit at least $100, you get 5 stocks right off the bat. No questions asked, guaranteed. And if you don't like the Moomoo platform, which I doubt you won't like it, I think you will like it. But if you don't, you can take out all the money you deposited and you keep all your free stocks, guys. So in my opinion, it's a no-brainer. And of course, it helps out the channel. It is an affiliate link. I appreciate you all as always. So use that Moomoo link down below. And with that being said, cheers. I'll see you in the next one.